Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have George Kaloudis, research analyst with CoinDesk, a media platform for the next generation of investors, exploring how cryptocurrencies and digital assets are contributing to the evolution of the global financial system. Experts from CoinDesk join us exclusively on Trade Talks each month to discuss trends in their digital asset space. For this segment, we have George. He's going to join us to discuss CoinDesk's third quarter market report, trends driving the digital asset markets, focusing on Bitcoin, Ethereum, DeFi, and more. George, it's great to have you with us. Welcome to Trade Talks.
Hey, Jill. Thanks for having me.
All right, you got it. And overall, how did assets perform for Q3?
Yeah, so just looking back a little bit to what happened over the last quarter, because sort of what's happened in October is crazy, but Bitcoin and Ethereum performed really well, especially when you compare it to most other macro assets. Bitcoin was up 25% and Ethereum was up 32%. Bitcoin finished the quarter around 44,000 and Ethereum ended around 3,000. And like I said, those numbers already sound stale. Bitcoin is trading around $62,000. It's up 40%. And Ethereum is somewhere around 3,800 right now, up 25%. And even if you look at the end of last quarter, we had a bad September from a price perspective. It's actually somewhat of a trend to see Bitcoin and Ethereum trend down in September. And that's happened since 2017. But clearly now they're back on a tear and they're bouncing back from that poor end of the last quarter.
Yeah, it really is quite remarkable as we're speaking here on Monday, October 18th, to what we saw at the end of September. It really is quite incredible the move that it's had. So, George, how important is it that Bitcoin is uncorrelated to macro assets? And what about Ethereum being correlated to Bitcoin?
Yeah, it's a really interesting development for Bitcoin because the story of uncorrelation to the macro assets and the whims of the legacy financial system was one of the early calling calls of Bitcoin. That was somewhat problematic in the earlier days as Bitcoin searched for its footing. For example, just last year in Q3 2020, Bitcoin and gold had somewhat of a moderate positive correlation. But now for basically all of 2021, BTC has remained uncorrelated to the macro assets, gold, S&P 500, and bonds. And that puts it in a unique wrapper for the investors that are determining their investment thesis around Bitcoin. Now, investment managers can think about portfolio construction with an asset that is uncorrelated to everything, right? This is a really interesting dynamic. It also brings up the question on if BTC is a risk on or risk off asset. And I think the answer is, well, it depends on who you ask. The data shows that Bitcoin is increasing in its correlation to S&P, and it is somewhat of inverse correlation to gold. Now, mind you, these are very small correlations, which is why we say it's uncorrelated. So people would say it's maybe risk on. Is it risk off? I like to say it's risk everything. It fits into many different investment theses at the moment. It's still a very young asset. People can look into it as a way to get outsized returns, and some people use it as a hedge against the evil TradFi. When looking at Ethereum and how it is correlated to Bitcoin, it's a pretty interesting dynamic, I think. We'll never probably ever see Ethereum diverge from a correlation to Bitcoin. And I think that's important for people who don't buy into the Bitcoin thesis. They don't care very much about the freedom money. They don't care about the digital gold, but they want to invest into the future of Web3 or whatever they think Ethereum promises them. You're still going to have to look at Bitcoin and see what Bitcoin is doing. If Bitcoin's tanking, you probably want to think about, okay, well, is my Ethereum or XYZ ERC20 token going to fall as well?
Yeah, that's a great point that you make, George. This think is something that we're going to have to live with as people who invest in the digital asset space. Does declining liquidity pose an issue as people get interested in Bitcoin and want to get that exposure to the underlying asset?
Yeah, and I want to be clear, when we talk about liquidity in the Bitcoin world, there are two types of liquidity. It's super confusing. We probably should change the word that we use, but we have two metrics. We talk about on-chain liquidity and we talk about market liquidity. So definitely understand why that's confusing. But when we talk about declining liquidity, what we mean in the Bitcoin world is that we have declining on-chain liquidity. And in short, what that means is the ratio of the amount of Bitcoin that has moved recently versus the amount that has not moved recently has decreased. So all that suggests is that people who hold Bitcoin are holding stronger and they have stronger holding behaviors. And they're hodling, as people like to say. And they're continuing to do that. On the flip side, this market liquidity for Bitcoin is never going to be a problem, especially in the near term. There have been a lot of exchanges that have been popping up. FTX is sort of the new darling where you can go buy your Bitcoin from. But this is a $1 trillion asset with many, many exchanges coming up, OTC desks, funds that offer Bitcoin. So I don't think at any time in the near term, certainly, but maybe even the medium to long term, if you and I want to buy Bitcoin, we're never going to have any trouble. Just because people are holding their Bitcoin on chain doesn't mean that you and I aren't going to be able to buy any.
And transaction fees for Bitcoin were really low in Q3. Is that problematic? And is that because of the Lightning Network, or is there something else at play here?
Yeah, Jill, it's a really interesting question because we don't necessarily have an answer yet. People, big critics of Bitcoin, have always talked about Bitcoin being very slow and having high transaction fees. And we expected with the price performance in Q3 for transaction fees to go up. That's usually what happens. But we saw this really, really low level of transaction fees happen in Q3. And we aren't necessarily sure why. It actually might be somewhat of a problem if this continues in the future. That just means that people aren't using the layer one Bitcoin blockchain. You mentioned the Lightning Network. That's actually something that might be taking volume away from actual just Bitcoin layer one transactions, because people in El Salvador who are using Bitcoin on a daily basis are using the Lightning Network. However, there's only 3,000 Bitcoin that are locked into the Lightning Network. So to suggest that 3,000 Bitcoin is what is making up all of the transaction volume for 18 million total Bitcoin is probably far-fetched. So we're not exactly sure what's going on. There may be just really strong holding behaviors, but for the moment, it's something that we're definitely keeping an eye on.
Let's switch gears a bit here. MEV growth clearly slowed during Q3. Is this strictly EIP 1559, or do any other factors play into this?
Yeah, Jill, I would love to be the Ethereum expert in our group, but I am not. My co-author, Teddy, is going to probably be laughing when he listens to this. But so I'm caveating, I'm not the Ethereum guy in our group. But there's this thing known as MEV, which is maximal extractable value, that miners of the Ethereum blockchain use to extract value from reordering transactions in blocks, which is unbeknownst to the user that initiated the transaction. This is largely viewed as a bad thing, but Ethereum had made that update that you talked about, EIP 1559 or 1559, and that implemented a fee structure that made it more difficult to take advantage of MEV, and it seemed to work. Now, that was coupled with lower transaction volumes on decentralized exchanges like Uniswap, but we can attribute it, or at least we think that we can attribute it to EIP 1559.
All right, and to wrap up here, let's talk about some regulation here. What's new on the regulatory front as it relates to proposals around taxes? Anything else to note with regulation?
Yeah, nothing really new in the tax discussion beyond something that I think a lot of Bitcoiners and digital asset proponents have been fighting for a while, in saying that when I buy something with Bitcoin, why is it a taxable event? Now, we've seen a lot of people say it's a commodity versus a currency. So that's an ongoing conversation that we're not going to talk about in the near term, I don't think. What I think we should think about in the near term from a regulation perspective is everyone's talking about ETFs, right? And I don't want to speculate here, but the futures ETF is certainly a start, but it should not be the end goal. This is not holding Bitcoin within a regulated ETF, right? This is holding futures contract in an ETF, and it's somewhat costly to maintain, to just be paper Bitcoin, to mock the price of spot Bitcoin. I think it's unnecessarily onerous for something that an individual can just get on their Coinbase account. I personally would hold off celebration on the futures ETF, but for the time being, it's where we are now. It's where the regulators are comfortable saying, okay, so we'll see where that goes going forward.
All right, George, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.